Right, I think we'll get going. So, as usual, I'll run through some news first, and then our guests this week are two of the managers of down Renewables Infrastructure. That fund's been maturing quite rapidly, actually, especially since we've last talked to them. So, I think it'd be quite interesting to see how they're doing. So, these are the news stories I picked out from the week. It's really a week where results have been dominating the headlines. There has been an awful lot of interesting stuff, but a couple of things that I thought might be worth delving into. First of these is Fundsmith merging Equities. I think there is a general consensus that this fund is quite disappointing. I think I just wanted to make the point here that actually it is probably worse than it looks. As you can see, it traded at a premium at launch. Investors kind of lost faith with it around 2019. It's been trading on a discount for most of the period since. And that pullback that you see there in the share price and the NAV means that now, with a share price of about 11.50p, it's really only returned you about 2% a year or something since launch. Not great. Here it is against the whole of the rest of the sector. It's still a reasonable size, 300 million quid, but it is trading quite a big discount now, as are quite a lot of these funds, actually. I think it's interesting that is, and so is Templeton. Yield's really negligible. That's not what it's designed to do. The ongoing charges, not fantastic, sort of kind of middle of that pack. There's the return numbers. And obviously you can see it held up relatively well over the past 12 months. But I'd say that it should have done much better than that, as I'll explain later. But what you can see is that they're just widening the discount. So even though it held up, the discount widened. And that is obvious as we come to the numbers in a minute. This is what it's trying to do. It's a normal kind of Terry Smith type approach to things. So really focus on quality, focus on cash generation, look at things on the basis of free cash flow yields, find good companies and stick with them. It did tweak its investment policy last year. They did, basically, they added in the bit there in pink. So they kind of broadened out the sectors that they might be interested in looking at. And that actually did lead to some elevated turnover. So 38 stock portfolio, but actually 7 new holdings and 7 exited. So quite a lot. So that thing about do nothing didn't really work last year. Here we are with some performance numbers that I just lifted from the fact sheet. I just wanted to make this point about how awful it's been. The benchmark equities is the MSCI Emerging Frontier Index. And as you can see there, so it's done 7% a year since inception, against the share price only done 2.4. So it's come off a little bit since then even. Obviously it's beaten cash, everything has. To be honest, I don't really think those two things, UK bonds and cash, should value comparisons, but they nevertheless stick them on the fact sheets anyway. So these are the results for 2021, which they published this week. So on the face of it, it looks good. So look at us, we beat our benchmark, up 3.8% against an index that was down 1.4. But because the discount widened, shareholders ended up with a return of minus 3.4. So obviously that wasn't great in the first place. It isn't buoyed by the dividend that some of the other funds have. I mean, the JP Morgan funds, they have found ways of paying out dividends even if you're not actually earning the income, and that obviously helps ratings, and they haven't done that. There is a continuation vote, but only if the discount exceeds 10% on average every year. And actually last year it was 6.6%. So there's no need to have a continuation vote. The director said there won't be one. I'd like to see them buying in more stock. So 300 million market cap, they could be a bit more aggressive about trying to control that discount, I think. One of the things that the board acknowledged when they published the results is that the asset allocation helps the fund. It was in favor of the fund, and it also helps it's got no Russia. But I just did a fairly basic calculation, just saying, looking at the opening asset allocation for the fund. If you just had index weightings in its asset in the asset allocation that it had, with a massively overweight to India, you would have returned 13%. So that kind of implies that they've lost almost 10% on their stock selection, and that clearly isn't great. So they called yes going to India, right, and that's underweight China, right? But they really should have been doing better than that. So all in all, I think still disappointing, and it's just a shame that funds like this get to carry on going when something like Jupiter Emerging has to go. And there we go. This is just a little thing, just looking at the portfolio. I just wanted to make the point here that it is ticking on those boxes in terms of what it's trying to do, in terms of return on capital employed, higher margins than the average fund, better cash conversion, better cash earnings growth. But you are paying up. So the fact that it's on these things are on lower yields mean they're much more expensive. And I think this, is the problem, is that I think they're paying too much for these stocks. If you go back to this thing about don't overpay based on free cash flow yield, I'm a bit worried that they are overpaying, but there we go. That's enough of that one. Renewables Infrastructure, great fund, 3 billion quid, one of the sector kind of flagships, doing quite well, trading a decent premium, definitely backing the trend for some of the other funds in the sector, on a 5% yield, which is okay. And actually the returns have been pretty good. We haven't yet got 10-year numbers for any of these things yet, but you see on the 5-year ones, the ones that we do have, it's second behind Greencoat UK Wind. The Bluefield Solar's up there. But actually, even these ones, 6-7%, they're not bad going. That's kind of what they said they were going to try and do. So I think all these funds are ticking the boxes and delivering, but has been doing particularly well, Renewables Infrastructure. This week, it announced it's buying a stake in Hornsey One offshore wind farm, which is a wind farm that's off the coast of Yorkshire. As you can see there in the little map. And it is the first phase of 3 wind farms that are going on there. It's already the world's largest operating wind farm, so it is capable of generating 1.2 gigawatts. Hornsey 2 will be a little bit bigger, but just to give you a flavour of what's going on this market, there are 3 wind farms being built on the Dogger Bank, imaginatively called Dogger A, B and C. Each of those is going to be 1.2 gigawatts. So the Hornsey One reckons it can do 1 million power, 1 million homes. These calculations seem to have changed recently, because Dogger originally said it could produce 6 million. But these are sizable things, and they're going to make a big difference to our energy mix in the UK. Hornsey One, and again, this is the other thing that I think is interesting. It's an older project, obviously, because that's which is the reason it's operating now. And the subsidies it gets are enormous compared to the subsidies that the Dogger Bank ones are going to get. So it's currently getting a guaranteed price for its electricity of just shy of £165 a megawatt, and it will carry on doing that for 13 years. And that, I think, should be impacted by inflation. I'll have to go and check that. And Dogger A is 47.2, which is clearly an awful lot lower. And so these wind farms are becoming more and more competitive. The basic point about giving you all of this is to look at the fact, so Renewables Infrastructure is only buying 7.8% stake in one of these big wind farms. And it's going to be a big chunk of its portfolio, so 8% of its portfolio. The opportunity here really is enormous. So at the moment, this is pre the deal. TRIG's portfolio is 36% in offshore wind. That's going to keep growing upwards as it adds projects like Hornsey. But it could, if it could raise more money and carry on buying these stakes, it could just be a multiple of the size it is now. So 3 billion quid now, it could easily be 10 without, and still not run out of things to invest in. All of these things are benefiting from higher power prices and inflation. Wind speeds were pretty awful actually in 2021 on average. And I think Greencoat UK wind generation is about 15% below budget, but they've picked up again recently, and Trig reckons that could add about 1p to its NAV. Higher power prices could add between 2 and 4p. They're not taking market rates of power for everything that they do. Some of the things are contracted. There's no mention of inflation, but obviously inflation, it does help subsidies, things like ROCs. So that's going to be good news for the NAV as well. So the NAV is 119 and is edging up. But it's raising money to buy this Hornsey thing, and that's coming at no less than 130p. So as a retail investor, you will be able to participate in this deal. There's Primary Bid doing an offer, and there's a link to that on the news story on our website, or through there's a page on our website too that's got links to all the share trading platforms, so you can go and find that. But the price of the fundraise is being set by a book build. So basically professional investors are going to be bidding how much they want to invest and what sort of price they want to invest at. And then once the company has decided how much money it wants to take, and all of these haven't been determined yet, then it will say, okay, we will take 300 million, 131p or whatever, and then that will be the price that you have to pay. So that's the way that's going to work. So what I'm saying is, although it looks like a big premium, it's going to be a smaller premium to the 190, because the 119 is going up, but you are still paying a chunky-ish premium to buy shares in Renewables Infrastructure. Now, Raven Property used to be called Raven Russia until 2018. To be honest, I don't think I tweeted that it had changed its name, because it was a big sort of constituent of the sector for a long time. And then it became more and more of a sort of a standalone property company and less of a fund. It's invested mainly in Russian warehouses and some office space. And if we go back to June, which is the last time we published the numbers, it was doing okay. And 96% of those were let. And it was the same story as we've got with Tritex Eurobox or Aberdeen Logistics, European Logistics Income. So there's huge demand for these sheds, the trend towards online shopping, the trend towards reshoring things, all of those things creating demand. So basically letting these things as fast as they can build them. It was one of the big bets of Woodford. And the highlight of the year last year was that it managed to buy its Invesco out of its stake in the company, because that had been an overhang for a long time. So quite a sort of complicated deal to put together, but effectively they set up a joint venture company with the senior management, and that joint venture bought back a lot of the shares. Some of them were placed with other investors and some of them were cancelled. So I think the thing to take away from that is that the senior management actually invested cash, real cash, into that fund in early 2021 at reasonable prices. I mean, depressed prices because of the Woodford overhang, but reasonable price that we paid for real money. The portfolio then was worth about 1.2 billion, more or less, but that was quite heavily leveraged. So debt was 673 million, preference shares of 252. So the NAV was 264 million, or about 50p a share at the end of June. The implication of that is it doesn't take an awful lot of a fall in the value of the properties to wipe out equity investors. So a 23% fall in the property valuation would wipe out equity investors. So that there's a reasonably certain that that's happened with what's been going on in Russia. In addition, though, 38% of that debt is in euros. And as we know, the rubles collapsed as well. So that does mean really that you can kind of slice it different ways, but the chances are really that the equity's been wiped out this company, and so it isn't really worth anything. And for that reason, that's one of the reasons why the board said basically we can't carry on going. So they've put together a deal which looks slightly strange, but there's a property company underneath the main holding company, that owns the property. That's been sold to a company in Cyprus for a nominal cost, and the Raven property listing is going to be cancelled. Technically, Raven property is still going to have some assets in terms of loans that are owed to it by the underlying property company. But realistically, there's no way the underlying property company can service that debt because it can't get money out of Russia. Raven property won't have any debt left on its balance sheet, but it's still got its liabilities to preference shareholders. So again, there's no way that the equity is worth anything. So unfortunately, if you were invested in that, you really have nothing left and no means of getting it back again, I think. There we go. That's enough from me. We are now going to